Hey there, welcome back to the Money Monday video series that I've created. Um, this is part one, and I call it being in the tranches. And we're going to talk more about what a tranche is, and I really didn't mispronounce that. It's not trench, it's tranche. But it's very important to this whole subject where we're going into. Also, what I want to go into is I want to dig deep in some things, but I'm not going to go in really deep because you don't need to. It's more of a 30,000-foot level of how things work in this financial structure I'm going to present to you. So let's get into it. What could have led to the 2008 economic crash? Also, what did I learn to save my 401k during that crash or before the crash happened? And what did I do to save it? I actually had some steps I had to do once I learned I was at risk. What did I do to fix that? And what the heck is a tranche? Hint, it's French. Okay, what happened back in the early 2000s that led to what happened in 2008? After the dot-com bubble burst in about 2000-ish, things started getting back to normal fairly quickly. And people thought, good times are here to stay, right? And what people started developing is what they call an optimistic mindset. In other words, doesn't really matter what happens. We're on an upward trajectory to good stuff. Basically, we can't lose. Rising markets will protect my principal. And just plain greed is what happened. And generally, as things go up in a normal market, it's kind of a slow slope. It's like a little bit more every day. Things get better, a little more inflation possibly. The value of things go up. My paycheck goes up, things like that. But this kind of was a feeding frenzy. And what happened is that everything started going up on a curve, started going up faster, quicker, and the like. So let's talk about how all this got started and what started it as far as of the markets going up. People started, what's the word I'm looking for? Started getting into a frenzy of we can't lose, okay? So think about what happened back before 2008. People were refinancing their mortgages. Interest rates were low. Jobs were good. We were building houses right and left all over the place. And lenders were making it extremely easy and easier to get a mortgage. And it got to the point to where the frenzy got, like I said before on the previous slide, was that people didn't think things were going to reverse, okay, which they always do. What comes up must come down. And the value of property was going up so fast that they figure that if things did fall apart, by the time they did, the value of the property would be so high that whatever was lost would be on the plus side. You know what I'm saying? Like $100,000 house would be worth over $200,000, and if it fell back, it would be $150,000. You're still in the positive. Okay, so there was incentives all over the place to do giving out loans, especially mortgages. It got to the point to where loan officers, if you want to call them that, mortgage brokers, they basically got to the point to where they were moving so fast, they didn't stop to make sure, to verify everything that was on the forms was true. Okay, background checks, financial checks, whatever. It got to the point where they were filling out what they called, or what was called, liar loans. In other words, I walk into a mortgage company and say, hey, I need a $1 million mortgage because I'm going to buy $1 million house or $1.5 million, whatever. And so instead of coming up with documents to prove that I was making that much a year or that I had that kind of resources in the bank to do it down and do closing, they just took your word for it. it's part of human nature. When you're making that kind of money, you start cutting corners. And I'll show this in some other areas as well. Because every time a mortgage was created, okay, and you get it funded and you go buy your property, whatever, that mortgage doesn't sit with the originator, okay, whether it's a mortgage company or a bank or whatever. They don't hold on to that. You're not paying them. You may look like you're paying them down the line when you're writing off to the Bank of America. Bank of America may not have that mortgage anymore. They sell those to other entities that package them up. So it's kind of like a mutual fund, say, for stocks and bond or stocks, is that has several mortgages in it, and people will invest in that. They'll buy into that to make some money. And so it's called a mortgage-backed security is what they create. Okay, that's farther down the line, and it's aggregated by type and risk profile. And what I mean by that is, actually, let me draw it on the board. Let's see if how this looks here. Get that out of the way. So let's get into tranches now. Tranches means slices. Like French would say, I want to have a tranche of pizza, please. So what they are, think of them as like being buckets. And on and on and on they go down. Whoops. So much for my art training. Anyhow, each one of these buckets is a tranche. It'll have certain types of mortgages in it combined. It depends on the property. It depends on different things they look at. What is the FICO score of the person taking out the loan? Things like that. And so it's based on type of property, whether it's commercial or residential, things like that. Also, it's based on what are the risk factors of the person taking out the loan. Just like when you go get a loan, they look at your credit history, your work history, your FICO scores, things like that to see what kind of risk you are. If you're buying a house, say for instance, let's go down here, buying a house, and you got windows and a door. When you buy a house, generally the bank wants you to have some skin in the game, okay? So say for instance, the house is being bought for $100,000, okay? The bank will pay maybe up to 80% of the purchase of that. You're gonna have to come up with the next 20% up here, okay? Well, the more you put down, the less of a risk that mortgage is. The reason being is if they have to foreclose on you or something happens in the market, they have some equity, some leeway here to get their money back, all right? So that's the kind of stuff they're looking at. Whoops. So if, say for instance, you got mortgages in this first one here, let's call it AAA. And the reason why I call it AAA is that everything in markets is rated by the quality of it. AAA, AA, A, and on down. So when you get something that is rated AAA, that means the risk is low, but also the risk is low, also your return is low. Why is that? Because when someone has a really good credit score, is a really good credit risk, their mortgage tends to be not only the payments are lower, they may get it for a longer period, they may get loans that are larger than most people. Payments and interest are lower. So basically they got a good deal, okay? So as you go down here, the risk goes up. That means people down here have less time in their current job. They may have some black marks on their credit report. They're getting a higher it's a higher interest loan. They're asking for more than the 80-20 rule for buying real estate, things like that. And it goes on down. So that's what a tranche is. So what it is like kind of mortgages in each tranche. And then institutions and individuals, just like a mutual fund, like I was talking about before, will buy into that as an investment. So either they can invest in for appreciation or for cash flow. You know, every month or every year they get an interest check back from their investment. And so that's why people buy it. It's another traded stock, not like a stock, but it's like a stock. Anyhow, it's another traded entity so that people can make money off their money. All right. And then the reason why these get put in there, again, I'm going to repeat this, is the reason why they go in here, people don't hold on to it, because generally banks don't have that kind of money. They're not going to hold that mortgage for 30 years. But the person that's processing the mortgage, the broker, whatever, they just make a commission or a fee. They structure the loan, they get it all set up, they get the appraiser and all that kind of stuff done on the property. So they get all that done. So in closing, the mortgage is funded. And then as soon as that's done, they turn around and sell that. So they get their money back to use again, plus a fee or a commission. That's how they make their money, all right? So I'm gonna leave this up here for now. How did I learn about how this works? I didn't go to school. I'm not a business major. I'm not a finance major. I'm a frickin' psych major, okay? So, but I just have this interest, and I have had it for a long time. Like I said in the last video, you know, I've been an investor, real estate investor, and I've also been a real estate salesperson. So I have that training and experience, but also I just had this thing about learning everything about it, because my whole life since I was in college, I wanted to learn how to have my money make more money for me. I wanted my money to work for me as opposed to me just working for it. So I was like a sponge. I was listening and reading to everything I could. When I was driving to and from work, I would either be listening to a podcast, an audiobook, whatever. And so I was trying to learn things. And one of the podcasts I listened to at the time was the Rich Dad Radio Show, which was also a podcast. And so since I was going to and from work, I would listen to that. Robert Kiyosaki, who is the Rich Dad Radio Show's, host, would have on different people over time. And each one had their own specialty in finance or investments, things like that. And so when this whole thing going crazy with real estate primarily, which is what his focus was back in the day, was real estate, is they talked about how the mortgages work, okay? And on an even higher level, I kind of knew how this was going on, but the inner workings I didn't quite have. So one of his guests, and I can't remember, I tried to look it up before I did this video, which one he was talking to, but what he was talking about is what I call the hot dog effect. And they talked about how these tranches affect the market. Like I said, they're traded. This is an entity or something you can invest into, okay? Just like a stock, all right? Well, I call it the hot dog effect. My analogy is the hot dog effect. And so people who, like appraisers, things like that, they have a vested interest. And whether someone's doing research for a company or whatever, is they tend, and it's human nature, it's not saying that they're bad people, but they tend to give in to what the people that are paying them want, the outcome, okay? Whether it's research or an appraisal. It's one of the reasons we had to go through that whole thing with appraisers to get it to where they can't talk to anybody. Really mess things up. But anyhow, so what happened over time is there was pressure to get these mortgages in these tranches. Well, what they found out, what this guy found out was that even though this is rated as AAA, some of these other ones were getting in here, the more risky ones. Okay, so people, when things go crazy, they tend to put their money into a sure bet as opposed to risk. Because when there's a risk, there's a higher payoff, which I explained before. So what he was noticing is that these were going in here. So like AA or A was going to AAA, whatever. And so this isn't truly AAA anymore. It's got higher risk, even though it's paying out just a little bit of low risk interest, okay? And so what he was saying is that when things start falling apart, like people can't pay their mortgage anymore, they go into foreclosure, whatever. When the house of cards starts tumbling down, it's going to take this with it. So when people started going, hey, things are getting really crazy, I want to get away from these high risk, high income loans and get them into the AAAs. Well, what they found out is that the AAAs weren't really AAA. Now, what I mean by the hot dog analogy is if you know anything about what goes in the hot dogs, they say it's all beef. I'll let you look it up. It's not as good as actually having a steak, okay? So there's a lot of crap in here, a lot of bug parts, things like that. And so because of that, the whole market started to collapse on itself. And so what was rated AAA is no longer AAA, what's AA is no longer AA. I hope this makes sense to you. But anyhow, those kind of things, and because of things like greed, as we started going negative, we started going down, and the market started going down. It was just a domino effect. Everything was going. I mean, there was like people were losing their jobs, especially in finance, like banking, mortgages, real estate. They were losing their jobs, and it just trickled all the way down. I worked in aerospace at the time. They started laying off in there. Let me tell you something. The whole time I have been in my career, which was IT and aerospace, I never really worried about getting laid off. Why? Because there was always a part of aerospace that was doing well when the other part was doing poorly. This is something to where there's no place to run and hide. I mean, every industry was affected, okay? So people quit spending, people quit buying, people didn't have jobs so they couldn't buy, they couldn't pay their mortgage, their car payment. I mean, it just fell apart. Okay, so how did I fix that? When I started listening to these people, I started listening to more people that talk about it, or this one person that was talking about the tranches. And if he was on someone else's show, I'd listen to see if I could learn a little bit more. Now that I know that my 401k was at risk because he was talking about how this is going to bring the whole market down, stock market, everything, I thought, I've got a nest egg here. What am I going to do with it? I got to put it someplace, right? So I started looking at my 401k, and depending on the company you work for or how your 401k is set up, it's different for everybody. But where I worked, there were several, I don't know what I want to use for a symbol here, different places you could put your 401k money into, okay? One was like the Russell, was it 1,000, 5,000, something like that. That was a small cap stock. Cap means how much is the company capitalized. In other words, it's a smaller company, basically. That's what that means. And then you have mid cap and high cap stocks. There were some of these different investments that were for foreign companies. Some were just American companies. There was one that was just for my employer. I stayed away from that. Yeah, we'll talk about this some other time when I talk about Enron. If you remember back when Enron went, up, those people lost everything. They lost their retirement, their job. I mean, they were completely wiped out. So anyhow, all these different places you could put your money in, and they were all stocks. And then they had this one, and I think a lot of the different 401ks have things like it, or something you can put in your 401k. It's called the stable value fund. And what does that mean? Okay, generally it means it's like an annuity. And what an annuity is, it's related to insurance companies. What they will do is they will promise you a very small income from the money you put in it, but it's like guaranteed. Unlike the stocks to where it grows and you can get a lot out of it on a good upward market. This is basically, no matter what happens, you're getting the same thing. The bottom line is you don't lose your principal. In other words, the money you put into it, you don't lose. Your interest or your income from it may go down a little bit, but it doesn't go away, okay? So generally when you get in your 401k, you want it to grow. You want to add to it. You want it to have interest. You wanted those stocks that are inside the different buckets here, that you want them to go up. So when you retire, you have money to live off of, okay? So what I did is I took all of this. Let's get one I can open here. New markers. I took all of this and put it in here. Now here's the thing that was kind of frustrating for me and very sad. Sad because I got to watch some of my coworkers lose 50% of their retirement because they said, my advisor says to do this, keep the course. Well, in most cases, when you're having a little dip, that's the way you do. But this is a fairly major crash. And so anyhow, put all of my 401k money in there because I learned about how mortgage-backed securities worked and how the falling stock market was going to crash everything else. So that's how I got into it. So as we got closer to 2008, things started going downhill. I mean, what they were predicting actually happened. And after I put all my money into that stable value fund, I started watching the stock market. The stocks were going down, real estate values were falling, bank closures. We'll talk more about how FDIC works and how people lost money because they misunderstood how that works. Jobs in all sectors were being lost, especially finance and real estate. And I watched my 401k. I watched all the other places where I had my money and how they were going down. And mine was flat. I didn't lose a penny. Now, is that because I'm smart? No, I wasn't born with this. It's because I studied. So what I recommend is, turn your car into a mobile university. Listen to podcasts, listen to books, audio books, things like that. Check things out from the library, YouTube, whatever. Start learning things. I mean, when you're sitting in the car, don't listen to music or the news, or what the news is going to depress you anyhow. Learn how you can win and how you can protect your assets. Okay, so what is the moral of the story for this? Anything you invest into, be it large or small, commercial real estate, silver, gold, Bitcoin, anything like that, learn about it. Now, you don't have to become an expert. I mean, there are experts out there. I mean, it's okay to get professional help. I recommend it because you're going to learn from them as well. But don't be 100% dependent on the professionals, the experts, because what's going to happen is that, like some of my friends, some of my coworkers who are very close to retirement lost 50% of their 401k plus, and because they were so close to retirement, didn't have the time to recoup what they had lost. When the markets start to turn up or down, study why they're doing that. That's what I did. And this was like a very unique case, but since I knew the nuts and bolts about how mortgage-backed securities work, again, because I was interested in real estate, it gave me some preparation to save what I had. I didn't even know I was going to save that much. I thought I was going to get hit pretty hard too. Learn about how it works. Know what your alternatives are. So if things are starting to go down, where can you take that money and put it someplace that's safe from that condition in the market? Sometimes real estate goes up and other things go down, and sometimes you need to make a shift. You liquidate the stuff that looks like it's going to go down, you put the stuff going up so you can, keep growing even in a down market, whatever market that is. So you need to know what your alternatives are. Fortunately for me, in my 401k, they had the stable value fund, and I was able to move that money in there pretty quickly so that I wouldn't lose it. Also, make your own decisions. Okay, we're all adults here. We have to know what's going on in the world and how it's affecting us. And we have to make decisions. Sometimes they may be the wrong decisions. I mean, even the most wealthiest people in the world sometimes make a boo-boo and they end up going bankrupt, all right? So make your own decisions. Don't just hand it over to someone and say they'll take care of it, because, you know, no one has your interest in mind or in their heart as much as you do with your own interest. And finally, this is my mantra. Always, always do your own homework. You know, if someone tells you something like this is a really good deal and you don't know anything about that investment or that deal, do some research to see if they're telling you the truth, and if that's something you really want to go into, pros and cons. All right, so that's it for this week. Next week's video, not quite sure where we're going to go with that next. I think I might start some of the Cash Flow 101. Talk about what kind of things it's going to teach us and what we should keep our eyes open about when we look into that game, and some of the things I've learned, and that's also helped me with my investments. So anyhow, that's all for this week. I hope you got something out of it. But anyhow, again, do your own homework. When stuff's coming down the pike, don't stick your head in the sand and hope for the best. Learn and get prepared. Put on your armor and get ready to fight for what's yours. So for now, have a good week, and we'll see you at the next video. Take care.